It's great to be here and great to attend and participate your fifth Swiss Asset Management Day. So as Mr. Baumann said, I would like to talk about infrastructure. I would like to talk about infrastructure as an asset class. And you will see as we have the next 20 to 25 minutes, hopefully five minutes for short Q&A. You will see that we're going to go along actually the environment. Why is it important for us as institutional investor, as an insurance company, as a proprietary asset management? Why is it important that we actually lower the barriers of investment in infrastructure debt? Why is it a win-win? What are the opportunities out there, and also what needs to happen on the market front, but also on the policy front, so that we can create the win-win. Infrastructure and asset class, you will see also throughout the presentation that there are great opportunities out there, great opportunity out there also in terms of growth, and this is why when thinking about infrastructure, the asset class to come, I think it's no coincidence, not just because it's the fifth Swiss Asset Management Day. Actually, there's an opportunity to create another Switzerland, but I will talk more about that later on. Well, first of all, let's talk the numbers in the first section out of the three sections of this short presentation. I mean, everyone knows growth is weak. Everyone knows market volatility has been great. It has surprised many at the beginning of the year. I probably rightly expect also that market volatility will not vanish. If you take a step back, however, if you take a step back from the day-to-day, week-to-week kind of market-related news and look at the macro environment pre-crisis to now, I think it's quite discerning to see that the pre-crisis GDP growth environment was much, much higher, almost 3% at 2.8% if you look at the period from 2003 to 2007. When you look at the current growth environment in advanced economies, 1.8%. In the US, we are waiting now for the newest forecast figures from the IMF at the beginning of next week as the spring meeting is starting. It's probably going to be around 2.2, 2.3%. It's okay growth, but it's nothing stellar. And definitely from where we are coming from, being in a recovery phase, this growth environment is anything than good. We also know, I think this is important also, as we look as also us as Swiss Re, as an institutional investor, as we look into investing our assets, I think we should be very mindful also, not just about the growth environment, which is low and fragile and still given the policy environment, still is exposed to many setbacks, but also on the political front, exposed to many setbacks. I think it's very important also to be mindful about the legacy of the crisis and also the high debt environment, especially the high public debt environment and the public debt overhang in which we are living today. Before the crisis, 2007, you have the figures here, 72%. Now, latest figures, it has advanced to more than 100%. If you look for the US alone, for the US economy alone, within that time period, 2008, 2014, the increase in public debt is about $9 trillion, and that's the size of China. Hence, a clear headwind also for growth, also for investments, and in my view, also something which continues to create a volatility as we try to find a new equilibrium and as we try to find new growth drivers. You just mentioned before in your introductory remarks the search for yield. This morning, you were talking about also negative yield environment. For us as an insurance company, obviously, having a stable yield environment is important. Ideally, having a positive yield environment, however, would also be nice. Unfortunately, this is not what we have today. Globally, if you look at globally, European, actually for European government bond markets, you see that 40% of sovereign bonds trade into negative territory, so huge challenges, and I think that's one more reason why we have to look at other asset classes classes. That's one more reason, I think, that institutional investors, especially real money investors, need to be out there in the public policy domain as well, and argue with the policymakers that it's important to unlock the barriers for investment in infrastructure debt. But I will speak about that more broadly. So if you look Europe, as I said before, 40% of sovereign bond market is a negative territory. If you look at globally at the figure, what is below 1%, it's the majority. And also in Europe, you have a very seizable corporate debt market, which is also yielding negative rates. I think the latest figures are around 14 trillion. And as a matter of fact, also here in Switzerland, about 1 year ago, unfortunately, it's almost kind of an anniversary. 1 year ago, you had the first 10-year sovereign debt issuance at a negative rate, which is also a novum, not just for Switzerland, but globally. Bottom line, financial repression, yes, it matters. I think it matters for us as real money investors in terms of managing our assets. I think it also matters for the real economy. It also matters for financial market stability. First of all, belief financial repression, which I would summarize as the activities by the central banks, and I have also worked in the central bank domain area previously. I think central bank policies, together with regulatory policies, they do not strengthen private capital markets, and neither do they support actually the benefits that are out there in terms of long-term investors and their potential to contribute to the real economy. In my view, today's central bank policies are rather part of the problem than part of the solutions. I think we are still far away in terms of recognizing the role of long-term investors and the positive role of real economy and their investment thereof to create jobs, but also growth. Just very briefly, one statistic. Long-term investors globally, that's 27 trillion. That's a global figure. The 27 trillion, that's actually just Europe. If you look at the global figure, it's a multiple of that. It's about 3 to 4 times bigger than that. 27 trillion dollars under management. That's the figure for long-term investors here in Europe. That's more than 3 times. That's about 3 times the size of China. Hence, these are huge volumes. I think financial repression also matters because of the implication it has on the real economy. We have seen it since the crisis in the US, that the savings rates have adjusted. I think that's not just something which is confined to the US. You see actually households, they react to lower rates, and in that sense, it almost renders the intended effect from central bank policies, which was to create more consumption, it renders it ineffective. I think also, last but not least, it creates the wrong incentives, but I won't speak too much about that. Let's speak about briefly again about the importance of long-term investors, and then about the opportunities and what ideally we would like to see out there in terms of market changes. I think today is also about talking about innovative solutions, maybe not just talking about opportunities which are right away, and obviously there are infrastructure debt. We would wish that opportunities are greater, and we are not alone in that, but I will tell you more about that in a second. First of all, why is it a win-win? Why is it actually that infrastructure investment is a win-win? Why is it that in many G20 meetings, also very recently, the one I attended in Shanghai about a month ago, G20, the infrastructure investments is on the top of the agenda? It's because many research, many empirics, and as a matter of fact, if you look at how actually you can create and stimulate demand. Fact is, with 1 unit of infrastructure investments, you create, especially in a low yielding and low growth environment, 3 units of growth. So that's quite substantial. How you do it and which form you do it is also very important. And actually you see it's important, if you look at past experiences, that the private sector also invests alongside the public sector, not just the public sector alone. Also a quick overview in terms of some statistics, just to be mindful. Obviously, the growth is quite weak. The 1-to-3 relationship is out there. If you look also in terms of the market size, if you look at emerging infrastructure financing gap to 2030 on a cumulative basis, it's about 50 to 70 trillion dollars, so a huge gap that exists just in terms of needs to fulfill on the infrastructure front. If you translate this into annual basis, $1 trillion, and this is each year. So also not just from a new investment side, but just from an existing gap, it's huge holes which could be actually filled with the right policy and market mix. As mentioned previously, long-term investor base is very substantial, $70 trillion. Pension funds, insurance companies, as well as sovereign wealth funds, family offices, assets under management are included in here. And as you will see from this presentation, our vision, and here we are not alone, it's a vision shared with many banks, with also many insurance companies. We have also co-sponsored an important European initiative last year. Our vision would be actually to have a tradable asset class, to have infrastructure debt being something like a corporate debt paper that you can quite easily, I mean, I know on corporate debt front, you have also barriers. Nevertheless, you can access it quite easily through Bloomberg. Hence, if you could standardize the financial documentation as well as some other metrics behind it, you would go a long way in lowering the barriers, increase investor rights, and also provide for a real money investor some mitigation possibility to change the asset allocation, which is very important. Fact is, today, only a very small minority, 10% on the debt front, on infrastructure debt front, is really financed by some form of tradable instruments, the infrastructure bonds. If you would increase that share, you would increase for sure the overall cake which is out there for asset managers to invest in. Obviously, spreads might develop in the other way, that you might see some narrowing, but at least you would offer some alternatives relative to zero risk-weighted sovereign bonds, which I think is important to offer alternatives. And also, the zero risk-weighted sovereign bonds is nothing set in stone. Already yesterday, we heard the announcement from the Bank of International Settlement, which opened up the public consultation to review the zero-risk capital charge rate and process for banks with respect to sovereign bonds. One last point for this. On this slide, just looking again, just from the investor demand, and there are many surveys there. There could be one from BlackRock, as I saw also. Christian is speaking later. There are others out there, but surveys are very clear. Institutional investors, insurance companies, not only, but also pension funds, they would want to increase the target allocation to infrastructure debt. Overall, long-term investors, so pension funds, insurance companies, they remain well below the target allocation, about 2%. Now, thinking about the point made very at the beginning, creating another Switzerland, and how to profit from this win-win, how to profit from the situation that one unit of infrastructure debt investment would create in a low-growth environment 3 units of growth. I think the way to think about it is from the service, from the investor service, you have average target allocation 2.8%, so almost 3%. Average current allocation of insurers globally, a little bit below 2%. If you would get to the target allocation, and if you take into account the global insurance assets under management, roughly the $27 trillion, so this 1% of this $27 trillion, and you take the multiplier into account, then you create another Switzerland, the $1 trillion of growth. I think these are very important factors, very important multiplicative factors which are out there. In fact, for Europe, the average current allocation is actually even lower than 1.9%. It's 1%, meaning from a regulatory and market perspective, especially in Europe, there are a lot of barriers that need to be corrected. To summarize in terms of the bottom line, what we think as an insurance company, as a real money investor, what we would like to see to get this win-win. Let's first look at where we are now and where we should go. I think where we are now today, there are many impediments for investing into infrastructure debt. They are not just on the regulatory front. Today, actually, especially in Europe, the so-called Solvency II framework, which is the regulatory framework for insurance companies, they have adjusted the regulatory framework, and we welcome that a lot. They have adjusted the regulatory capital charges for 20-year BBB investments from about 40% to 20%, so very seasonable reduction. That's good, but there are other impediments, and mostly the impediments actually that you have an asymmetry in terms of the monopoly of the public sector over the legal environment, obviously, but also about the tariff structure and the asymmetry that the investors actually is at the lower end and lower receiving end. And very fact is also you have very much a change in the financial market landscape, which is still happening. Banks being under pressure on the regulatory front. I mentioned Basel III, probably going to see a change on the zero risk-weighted capital charge as well, meaning that there needs to be other funding sources for infrastructure financing, and the asset management industry or the real money investor community is clearly out there, which could tap in if the environment would be favorable. Fact is also, as I said before, 1 trillion in infrastructure gap is a very important gap. We think there are 4 important factors in this debate. On the policy front, what we would like to see, first of all, the recognition that infrastructure is important for growth. I think here we can tick it off. I think that it's very well recognized. It's a priority of the G20 since the leadership of Australia under the G20 2 years ago. This year also China had to keep it on top of the list for the priority areas, and I wouldn't expect any change with that in that respect when Germany takes over the G20 leadership next year. I think clearly in order to lower the infrastructure financing gap, but also for real money investors to provide assets with the steady cash flow attributions and characteristics which are so favorable, especially for insurance companies on the asset side, to match their liabilities with. We need to activate the long-term investor community, and that can only be activated if the barriers for investments are lowered. In order to lower the barriers for investments, and this is the third point, we believe very much we need to standardize, make a push towards standardization on the infrastructure debt front. There's a proposal out there from the European Financial Services Roundtable, which I co-chaired last year with banks together. We would very much hope that this becomes industry standard. But we can't stop there. And that's last point, number 4. We need also the multilateral development banks, the World Banks, the IFC, which are very active on the project finance front, also to buy into the standards in terms of what needs in any financial market instrument or template, what is kind of standard information and transparent, so that it can be put very easily into a Bloomberg. So that's obviously where we should go. Touched very briefly about the investment opportunity by mentioning the very steady cash flow, and obviously these are all long-dated instruments, so very favorable for an insurance company who has long-dated liabilities. The fact is, however, if you look at the credit losses or the recovery rate, they are very favorable on the infrastructure debt front. If you compare infrastructure debt and the average rating of infrastructure debt of this 56 basis points 5-year cumulative credit loss rate. That is comparable actually to single B AA, so lower to medium investment grade corporate debt, which has 5-year accumulative credit loss of around 119 basis points. But fact is, the current recovery rate of infrastructure debt is more comparable to a high-grade corporate debt. So very favorable recovery rates, that's the bottom line. That's also why we think, and other peers, I think infrastructure debt is a great investment opportunity. Obviously, the recovery is the one point, duration is the other, I mentioned already, and the third is also obviously the spread pickup. That you get the spread pickup also, which remains and has remained rather volatile, as you see in the graph on the lower side. During the crisis 2008-2009, you didn't see these blowout in spreads for infrastructure debt that you had seen for corporate debt. I mentioned the importance of standardization. I mentioned we would like to see the tradable asset class. Fact is also, if you look at equity, most of it is tradable. However, infrastructure debt, 90% is non-tradable. If you change these mechanics, you will get the more investors out there and you would lower the barriers of investments. I will skip this for the sake of time. Mention briefly the importance of strengthening private capital markets. Our push here from Swiss Re is not because we have a platform for infrastructure investments, but we care about financial market stability. We care about the environment we operate in. If you have a stable financial market environment, it profits us, profits our clients, and it profits the real economy. Just want to draw our attention in terms of our thought pieces that are out there, be it on strengthening the role of long-term investors, be it on infrastructure investing, which is a topic now, or be it on financial repression, the unintended consequences. With this, and being mindful that I don't have much time, we'll just say 1 minute, the key takeaways, and then if you still have time for 2 or 3 minutes for the Q&A, obviously activating long-term investor base is key. They need to be activated, they need to be incentivized to invest, but they can only invest if they also have some assurances that the political risk, which is the biggest risk for any infrastructure investments, is being somewhat tackled. In our view, standardization or having a tradable asset class is the best risk mitigation strategy. And with that, I already close this presentation. I'm happy to open up for any Q&A if you have still some time. Thank you.
Thank you very much. Thank you.
Thank you.
Yeah. We maybe have a little bit time for one question. I don't want to prevent you for asking Mr. Haegeli about this subject, this very interesting subject. So is there a question in the room, maybe? No? So maybe... No? Okay, so maybe I ask you one last question. How is Swiss Re tackling this investment or this asset class? Mm-hmm. You mentioned, you name it an asset class. In the practice, what is Swiss Re actually doing?
No, thanks for that question. So we have a global, obviously we have a global portfolio on the liability side, and on the asset side is also a global portfolio as well. We are tackling the infrastructure investment side through external managers, and we retain, however, control on each investments. We look at each transaction, single transactions, but it needs to fit our investment risk appetite, our investment strategy, and being mindful that political risk is the biggest risk out there. We are quite strict in terms of the mandates and also in terms of our risk profile. But it's also through external managers, and we have investments on both, on infrastructure, equity, as well as on infrastructure debt front.
Okay, thank you very much.
Thank you.
Thank you.